Welcome to EIKV and this is Vishnu. So in this illustration they have given the details of Triggers Textiles Limited, and you are the cost accountant, and the costing profit as well as the finance profit as given. Costing profit as 20 lakh 10,500 and the financial profit as 22 lakh 14,100. As the cost accountant of the company, you need to make a costing reconciliation statement, and some of the details of the company are also given in the illustration. So some of the details are: profit on sale of fixed asset has been given, loss on sale of investment has been given, voluntary retirement compensation has been given, donation paid amount has been given, insurance claim related to the previous year which is received by the company has been given, profit from retail trading activity, then interest income for intercorporate debt, then stock details, opening stock and closing stock of closing stock of work in progress and finished goods of the both, valuation of financial accounts and valuation of cost account has been given, and you are required to prepare a costing reconciliation statement. So I am directly going for the solution, the reconciliation statement. So when we have checked, I have made the profit as per financial statement. So we have two options: either we start with costing profit or we can start with financial profit. So in all the illustration we are started with financial profit, so we can go ahead with financial profit, otherwise you will be getting more confused. Starting with financial profit, and we need to less income not considered in cost statement. So some of the income which is not considered in cost statements are profit on sale of fixed asset, then insurance claim related to the previous year, profit from retail trading activity, okay, interest income from intercorporate deposit. So some of these are some of the incomes which has been affected or reflected in financial statements, so which is affected in financial profit. So but these incomes are not forming part of costing records or cost accounts, therefore we need to deduct such amount to get costing profit. Then other expenses, add expenses which are not considered in cost statement. So some of the expenses which is not considered in costing are loss in sale of fixed asset, voluntary retirement compensation, donation paid. So these three heads of expenses, these three heads of expenses are reflected in financial statements, which will not form part of cost statements or cost records. Therefore such expenses, we need to add such expenses to get the costing profit. Okay, then we have stock adjustment. For stock adjustment I have prepared a table. I have prepared, as per finance we have that 3 crore 82 lakh 6,430, and as per costing we have 3 crore 90 lakh 12,500. So when we take the difference, we'll get a difference of 8 lakh 670. So when we check these details, we can find that cost records is more, the valuation cost records is more than financial records. The difference is 8 lakh 6,070. So over here we have the difference of 8 lakh. Such amount we need to add back because we have the costing valuation is more than financial valuation. So the more amount, the difference amount is 8 lakh 6,070. So such amount needs to be adjusted in reconciliation statement to arrive at costing profit. So such amount needs to be added towards the financial profit to receive costing profit. So guys, I hope you got clear clarification regarding this illustration. Thanks for watching this video.